Okay, hello everybody. Welcome to Korean Atlanta Mentorship here with another video. So I actually just watched another YouTube video that said that if you turn on auto dubbing, it kills your YouTube channel reach. And I've been wondering why my YouTube channel reach has actually been going down lately. I wonder if it's because people are either sick of velocity banking or maybe I can blame the YouTube auto dub. So I turned off the auto dubbing off. So unfortunately in this video, you won't be able to hear it in Spanish, Polish, Japanese. I don't think they have auto dubbing in Korean though. Okay. All right. Well, let's go ahead and get started. Velocity banking. What is it? It's a debt payoff strategy. And in today's video, we're going to ask the question, why is it so easy to pay off debt? That's because if you know how to set it up correctly, then it's really easy, like set it and forget it. Remember this guy? Set it and forget it, and you just roast chicken? Well, we're going to roast debt with velocity banking. So let's go ahead and do that right here. And all you gotta do, first step is create a budget, right? Income, expenses, leftover checking, savings. And then we create the an expense breakdown, which lists every single debt that we have. And at the very last line, we have our personal expenses that are not tied to debt, right? Things we always have to pay for, food, gas, insurance, and all that other stuff, blah, 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 blah. So in velocity banking, it's pretty much the same thing, but the only difference, actually there's two differences, right? Is how we treat our checking and savings, right? How we treat our checking and savings, and where do we dump all our money, okay? When we do velocity banking, the checking account is the middleman, right? Whereas with average American banking, the checking account is the final destination of your money after you pay all the bills. That's really the only difference, right? Actually, there's another difference. So if the checking account is the middleman, what's the final destination? Well, it's called a line of credit. So if you don't know what a line of credit is, it's basically a financial tool where you could borrow money, pay it back, and then use it over and over again. That's what a line of credit is, okay? So this is a $373,500 home equity line of credit. So what does that mean? It basically means, okay, that you can just click a button on the bank's website and they'll dump up to $373,500 into your checking account. That's essentially what it means, right? And so what we're going to do is use something called a line of credit, and we're going to dump all our money into it strategically and increase something called our cash flow. So a lot of times people are very hesitant to do this because that literally means that you're wiping out your checking account every single month. The way that your checking account should look would be something like this. Money comes in and it just goes right out. Money comes in and it just goes right out, right? So at the end of the month should be about zero, okay? And so what we're going to do is assume we have something called a line of credit, right? And if to make the demonstration easy, we always assume free and clear, even though that's not realistic. And why is it not realistic? I'm going to tell you why it's not realistic. Banks don't lend money to people who need it, right? Banks don't lend money to people who need it. Okay. So if you're trying to get a line of credit at this time, at this moment, and you know, you're struggling, the bank ain't going to give you nothing, okay? We have to understand there's an order of operations. Like if you want to struggle after you don't need money, okay? But when you go to a bank, always go to a bank when you don't need money. And I say this as a person who has over $739,000 in lines of credit, including business credit cards, personal credit cards, which is a form of line of credit. You swipe, you pay it back, use it over and over again. Personal lines of credit, um, personal, business, home equity. I got it all. Okay, I got it all. All right. So, and also, by the way, if you don't know who I am, I paid off a mortgage in 2 years and 9 months. Right? Can't believe it's been that long. 2024. It's gonna be 2026 soon. I can't believe it. All right. So let's go ahead and get started and dump all of our money into here. Okay, not all of it. I'm just kidding. Some of our debts, and I'll show you why. So we have this formula called the cash flow index. So all it is um, a formula where it's the balance divided by the payment, right? Balance divided by payment, and then it gives you this arbitrary number, right? It gives you this arbitrary number, and so think of it as like a ranking system. Okay, so this is a ranking system. And so the lower the number, that means you get more bang for your buck for paying off that debt. Whereas the higher the number, that means you get less bang for your buck. So if I'm paying a $210,000 mortgage, I only get $1,200 of cash flow back. Whereas if I just pay this $30,000 credit card and maybe the $7,000 credit card, I get pretty much the same cash flow. Okay, so that's why it's smarter to pay the credit cards and not the mortgage first. Okay, you got to do it in order. So we're going to go ahead and do that. And I'm just going to do this 5, 8, 15, 27, 37, 10. Okay, and I'm going to go ahead and sum it up. So it's 102,000. So 102,000. And then this is what we're going to do, which is we're going to transfer some debt. And oh my goodness, look how easy this is. Look how easy. And this literally went from $590 of checking to $3,904 of cash flow. And so the cash flow amount is how much our debt is getting reduced. So what we do is we put our entire paycheck, the entire $8,000 into the line of credit, take our expenses out, and then rinse and repeat over and over again, right? Why is it so easy? Because once you have the good foundation and you learn to just kind of liquidate your checking all the time and take out your money from the line of credit and then move the debt to the credit line strategically, then you'll know what to do. All right, and then we're going to go ahead and do this, and then multiply by the interest rate, and then divide by 12. And now I'm going to go ahead and copy and paste this, yada, yada, yada. And then you see right here in month 29, okay, so 29 months, we paid off $102,000 of debt. Wow, that was so easy. And then we have auto loan, mortgage. So what we're going to do is we're going to do this 29, 29, 29, right? And then, so what we have this loan calculator right here where all I got to do is put the current month in. It's going to tell me the current balance. And then we just follow cash flow index again. So these are 2 auto loans. So let's figure out what the sum of it is, and it's 21 grand. We're going to move that into the line of credit. Let's go ahead and do that. So that's going to be plus 661.64, and then this is going to be 00, and then this is going to be $4,600 of cash flow. And let's go ahead and do this, and then this is going to be minus 4640.94. And then this is going to be 34 months, right? 34 months. And so we paid off the 2 auto loans at 34 months. And then this is going to be how much is it? 142K. Yeah, we got that. And then in this one right here, 210,000, right? 210,000 in 34 months. What's the balance? Where do we go? I don't even know where I'm going. Now it's 34 months. What's the balance of the mortgage? 202,000. So now the mortgage is really the only debt left, and we could just do one of 2 ways. We could just overpay it with our extra 4,000 cash directly as an overpayment, or you can use a line of credit. Now, what I want to show is that even if you use an 8 to 30% line of credit, you could still pay it off quickly. But obviously, the higher the interest rate, the worse it's going to be, but very slightly. And you might be asking, why in the world would I use a credit card to pay a mortgage, right? Well, pay it off quickly, get the points, and also expand your credit. I would say, like, if I'm going to use my credit cards, I don't want them to lie dormant. You see what I'm saying? And so if I can pay off my mortgage quickly and expand my credit, because for example, this one right here, this was originally a $10,000 credit card, and it magically turned to $17,500 one day when I woke up. Right? So, okay. All right. So now let's go ahead and do this. So 210,000, 34 months. So what we're going to do is something called chunking. And you might say, what is that? Just basically what we're doing is we're moving a piece of the loan into the line of credit and just kind of doing it over and over again. So the crazy thing about this is that even if you use high interest rate lines of credit, you could still pay it off. But if you move the whole thing into a line of credit, that's a no bueno. So let me just kind of show you here. So 210,000 is the original balance. Current balance is 202,273.17, 202,273.17. 30-year term, and payment amount is, what's the payment amount? 1259.06. And then all I gotta do is do this, and then blam, 3.2 years paid off, alakazam. All right, so now this is 0, and then this is 34 divided by 12 plus 3.2, and then 6.03 years, and then we are debt free. That was easy. Okay, that was relatively easy. All right, so yeah, this was a 10-minute video. So let's see if today's video comes out a little bit better now that I've turned off auto dubbing. Okay, all right, have a great day, everybody, and I'll see you on the next video. This is Karina Atlanta Mentorship.